I generally continue to much prefer Bitcoin over Ethereum. I've generally made the case that while I'm bullish on Bitcoin and stablecoins, I'm not really bullish on other crypto assets, including Ethereum. So I don't have a near-term price target. I don't think that this cycle is over yet. So I think we're going higher this cycle. I don't know if that means 150,000. I don't know if that means 200,000. I wouldn't try to guess.
Yeah.
At any given time, I'll assess market conditions, levels of euphoria, warning signs, or bullish signs. I'm still not too concerned with the end of the cycle.
Lyn Alden makes a critical distinction that's often misunderstood. She doesn't view Bitcoin or even gold as reliable hedges against CPI inflation. Why? Because when consumer price inflation spikes, central banks typically respond with hawkish policies raising interest rates, and ironically, that environment tends to suppress the price of scarce assets like gold or Bitcoin in a short term. Instead, Lyn reframes the conversation entirely. By the way, if you're enjoying this breakdown, make sure to like the video, subscribe, and drop a comment below. It not only helps the channel grow, but also signals to the algorithm to share this content with more people like you. Let's continue. She sees Bitcoin and gold as long-term hedges against monetary debasement, not short-term inflation. That means protection against the slow, grinding erosion of currency value caused by ever-expanding money supply. In this framework, the winning strategy isn't about timing CPI prints, it's about holding scarce assets that can't be diluted, inflated, or politically manipulated. Now, let's go back to the video.
I generally use hedge more sparingly because hedge protects you in a very specific environment. So if we were about
Right.
stocks going down, you buy puts, which is a hedge.
Hmm.
Um, Bitcoin and even gold are not necessarily CPI hedges because if you get a spike in CPI, you're more likely to get a hawkish central bank, which is generally not always great for scarce assets, at least temporarily. What I generally view it as, it's protection against long-term monetary debasement. So as currencies, the supply of currencies keep going up, you generally want to own scarcer things. And then for the scarcer things you own, you want to own best in class. So you want to own the best equities rather than the worst equities. You want to own the best commodities rather than the worst commodities. For the best commodities, generally speaking, that's gold. That's the lowest stock to flow ratio. That's the one with the most monetary premium. Bitcoin is the best in class for digital assets. It's got by far the biggest network effect, the most security, the most simple and robust design, the best kind of uh, structure to maintain its long-term decentralization. To answer your question, I don't view it too much as competition for gold for a couple reasons. One is I think that there's room for both of them.
Yeah.
Two, so far there's been different buyers. So central banks have been really, sizable buyers of gold as of late. Bitcoin is more like corporate buyers this cycle, to some extent, retail buyers. And the East is more active in gold markets, and the West is more active in Bitcoin markets, at least in this current cycle. So I don't view them as too much in competition. In addition, gold is much lower volatility. It's about 10 times larger of a market based on most estimates if you look at like the World Gold Council. Now we can audit the full supply of Bitcoin and know it down to the decimal point. We can't audit the full supply of gold, so we have to rely on estimates. But generally speaking, gold's about 10 times bigger. Obviously has a much longer track record. Where I would say that Bitcoin somewhat competes with is other precious metals exposures, generally the higher volatility ones. So historically, if someone was bullish on precious metals,
Hmm.
gold would be like the lower volatility one you might never sell. Whereas like silver, platinum, gold miners, these types of ones were generally considered more volatile plays on that trend. And I'd say to some extent they do compete with Bitcoin and maybe to some extent broader crypto, which is you have these more volatile non-fiat currency assets that now kind of fractures the liquidity to some extent, where buyers have more choices than they used to. So I do think that Bitcoin to some extent competes with that, but less so with gold,
Right.
at least anywhere in this cycle. I mean, I think all these trends support both Bitcoin and gold. I've been long both for many years.
Yeah.
The way I generally phrase it is if you start with a 60-40 portfolio, you might want to consider replacing some of your bonds with gold, and you might want to consider replacing some of your equities with Bitcoin. Because you're talking about different levels of volatility of the assets,
Right.
and that's so far been a great trade. Bitcoin's outperformed most equities, and gold's generally been much better to hold than most bonds, especially sovereign bonds, over 5+ years and counting. Longer term, depending on what starting point you want to go with. But basically, I think this is an environment where you continue to want to own scarce assets and notably want to hold scarce assets that are the best in class for whatever it
Mhm.
is that they do, and that they're not getting diluted in market share by other things. So if you own equities, you want to own the best ones at reasonable prices. If you want to own, crypto, you want to own the best and biggest self-sustaining network effect, in my opinion. I generally continue to much prefer Bitcoin over Ethereum. I've generally made the case that while I'm bullish on Bitcoin and stablecoins, I'm not really bullish on other crypto assets, including Ethereum. At times it can have a bull run in a trade and play catch up. But in general, because it's kind of Ethereum's kind of stuck in the middle ground where it's not as viewed as being decentralized and secure and risk minimized as Bitcoin. It has this additional complexity. It has changing monetary policy. We don't really know how many ETH are going to exist in 5 years. Could be more or less than we expect.
Right.
On the other hand, there are other networks that optimize more for scalability. And so Ethereum kind of finds itself in the middle ground of trying to justify itself as a long-term holding while also trying to compete with some of these faster networks that care even less about decentralization and try to just make fees and other things as low as possible. And so I think it's best to stick to the best in class one, which is Bitcoin. I think that's the one that's institutionally sufficient to put in major corporations and build ETFs around. But that doesn't mean that others won't have their time in the sun temporarily. I just think that long term, I'm not particularly bullish on the ETH BTC ratio. So I don't have a near term price target. I don't think that this cycle is over yet. So I
Okay.
think we're going higher this cycle. I don't know if that means 150,000. I don't know if that means 200,000. I wouldn't try to guess.
Yeah.
At any given time, I'll assess market conditions, levels of euphoria, warning signs, or bullish signs. I'm still not too concerned with the end of this cycle. Longer term, gold is something like 2% of global assets. So, there are various wealth reports by investment banks to try to categorize how many assets are in the world. It's somewhere in the ballpark of a quadrillion dollars worth of assets. So, 1,000 trillions worth of assets. That's equities, that's bonds, that's currency, that's real estate, that's gold, that's fine art, it's Bitcoin, and these things like that. Gold at something like a $20 trillion market cap, now a little higher, that's around 2% of global assets. And Bitcoin is something like a tenth of that, so that's about 0.2% of global assets. In general, I think that gold's probably headed higher than 2%. And I do think that Bitcoin can play catch up and eventually, breach 1% and then probably eventually get into multiple single percentages, which we start from a 0.2% base is obviously pretty bullish. So I do think that in the long arc of time, seven-figure Bitcoin is not unreasonable. I wouldn't call for it in the near term.
Lyn Alden also highlights a macro trend that's flying under the radar: the explosive rise of stablecoins. But here's a key insight: she doesn't see them as speculative assets. She sees them as something far more transformative: digital offshore bank accounts for the masses. For decades, only the wealthy had access to dollar-based offshore accounts, tools that protected their wealth from local currency risk, capital controls, and political instability. Now, stablecoins are democratizing that privilege. Today, anyone with a smartphone, even in unstable economies like Venezuela, Nigeria, or Argentina, can hold and transact in digital dollars instantly and cheaply. This shift is profound. It means the US dollar is going viral, not through banks or governments, but through open source protocols and peer-to-peer rails. It's not speculation, it's monetary escape velocity.
I view it as it's a useful addition to the
Yeah.
instruments that people have to own dollars. I've been on the record as being bullish on the amount of stable coins proliferating since early 2021.
Hmm.
Meaning that it's not really an investable trade because like unless you're the issuer, because stable coins are pegged to a dollar, but they have market implications globally. One way to think about it is that for decades, wealthy people had access to offshore bank accounts. And this is relevant in a world of, 180 different currencies, most of which debase very quickly and pegs break and inflation happens and authoritarian governments can seize assets. So all these kind of wealthy entities could have offshore bank accounts, and stablecoins are basically offshore bank accounts for the middle and working class. It
Right.
uses technology to compress the overhead, and it makes it easier to access custodial dollars and also use them as basically a checking account in dollars for those that don't have access to American banks or other developed market banks like Europe, Canada, these types of places. And so, Africa has 40 plus currencies. Imagine all the cross-border frictions of trying to trade. Latin America has something like 30 plus currencies. Again, all the cross-border frictions. Most of those currencies don't retain their value for very long. And so stablecoins are a way to access dollars globally. They basically digitize part of the Eurodollar market. So I don't really view them as necessarily adding fragility,
Right.
nor do I view them as a panacea for funding the government treasury. Though I guess the one caveat I would add is that as we see a little bit of top-down de-dollarization, meaning that, say, foreign central banks are not holding treasuries and buying treasuries at the rate that they used to, you still don't generally see any bottom-up de-dollarization. So
Right.
people in a developing country, if they want to hold a fiat currency for 3 months or 6 months for working capital, it'll generally be the dollar. And the stable coins allow a little bit more buying pressure because they can access them easier than they can access potentially other dollar instruments. Well, I would say, yeah, Bitcoin is the longer term answer here. Stablecoins are an additional top layer on the whole fiat stack.
Right.
Bitcoin is a competing bottom level asset. It competes with Fedwire and central banks as its own unit and settlement network that can't be arbitrarily frozen or otherwise controlled. Now, across the full stack, there are privacy considerations, including on Bitcoin. Generally speaking, it's easier to be private the smaller you are. Because privacy is very dependent on liquid privacy. Generally speaking, it's easier to get lost in a crowd if you're small, for example. And so, if there are entities around the world using VPNs and using stablecoins and stuff, they're probably reasonably safe, especially if they're not doing something that would attract a ton of negative attention. There are various privacy solutions for Bitcoin. Lightning Network is relatively private. Xiaomi and eCash is a layer of payments that is built on top of Bitcoin. That basically resurrects 40-year-old privacy technology that used to be developed for fiat, didn't really take off, and it's actually much better on an open source foundation like Bitcoin. So there are long-term privacy solutions here. But basically, Bitcoin is the one that's not just kind of instantly freezable.
Yeah.
Whereas stablecoins, just like a bank account, in many ways are. Bitcoin itself is anonymous in the sense
Yeah.
that if you acquire Bitcoin and then send Bitcoin, there's nothing that links it to you. Now, because a lot of exchanges and brokers are KYC'd, they're semi-effective at tracing Bitcoin. But especially as Bitcoin, if you look at the long arc of time, as Bitcoin circulates more, and if more merchants directly accept it for payment, all those payments become much harder to track. So in an environment where most people just buy from exchange and hold it, that's generally pretty traceable. But as that circulates more, it gets harder to trace. And especially as you use things like Lightning or Xiaomi and eCash, those that are trying to surveil it certainly have their work cut out for them. But I think even privacy aside, what these technologies generally do is put the onus on those trying to seize it or block it. So, for example, in many countries, you can just freeze someone's bank account before you charge them with a crime. Just because rule of law is generally more muddled. Whereas with assets like Bitcoin or to some extent gold, you have to take more action to either charge them with something or otherwise, basically physically confiscate the assets in question if possible.
Yeah.
And I think that's a healthy thing. Basically, there should be individuals. It's good for them to have various tools to make it harder to just with a stroke of a pen confiscate, liquid assets that they own.
Finally, Lyn Alden turns to Bitcoin's most underrated superpower, sovereignty. Unlike a traditional bank account which can be frozen, surveilled, or seized with a few keystrokes, Bitcoin is non-confiscable money, especially when self-custodied. It's not just a store of value, it's a shield. She acknowledges that Bitcoin isn't perfectly private today. Transactions on regulated exchanges are traceable, but the landscape is evolving. As adoption grows, peer-to-peer use expands, and technologies like the Lightning Network and Xiaomi and eCash layers mature. Bitcoin becomes harder to monitor and harder to stop. Crucially, Lyn reframes privacy and decentralization. They're not criminal tools, they're essential features for human freedom, especially in regions plagued by corruption, authoritarian rule, or collapsing financial institutions. Bitcoin, in this light, isn't just a hedge, it's a lifeline. Thanks for watching. If you found this valuable, the next video is even better. Click it now, and let's keep going.